There's a look at what's happening with North American stocks this morning. We also want to look at the performance for the Canadian market versus the S&P 500 so far this month. We'll get to that in just a second. And this is the chart we wanted to show because both indices are higher, but the American market is outpacing Canada, and that has a lot to do with energy struggles. Energy stocks make up a bigger percentage of the TSX than the S&P, and on the oil price itself, the three-month low in prices reflects the fact that the initial premium tied to the Israel-Hamas war faded. Meanwhile, the market seemed to be focusing on sloppier physical markets, growing inventories, and a drop in refinery profits. And so we wanted to check in with BNN Bloomberg regular Eric Nuttall, who is a notable Canadian investor in energy companies. He's with Ninepoint Partners. Good to see you.
Great to be here.
Okay, so for those who are trying to figure out what's happening in the oil market right now, you say what?
I know that's my job. And you did a better job than I can to explain this sell-off. This is the third huge sell-off, sharp, vicious, 15% plus sell-off that we've had. And when it's a good reminder, there are two markets for oil. It's annoying for investors, but you've got to remember it. There's the physical market where we can look at demand. We've got access to the best data sets of anyone. And I can tell you what global gasoline, diesel, and jet fuel demand is doing with a two-day lag. Perversely, as oil has sold off, you can see an inflection in the rate of growth. So demand is not an issue. Now, we can debate that the China normalization hasn't happened as quickly as people had hoped, but demand is not the issue. Neither is supply. Like, yes, supply has grown more than what we would have thought this year, largely due to the White House not enforcing sanctions on Iran. Their exports are up roughly 700,000 barrels per day, so that was unexpected. But generally, inventories have continued to fall. We're emerging out of the weakest period of demand where refineries are now emerging from turnaround season. We have inventories now sitting at least a 6-year low. That's as far back as satellite data goes. And so this just sharp sell-off, I really do think it's been a liquidation. We can see it in data. We'll get that reinforced next week. Just a massive liquidation in net speculative length due to non-fundamental issues.
So can we quantify the amount of the price of WTI that is, for lack of a better word, wiggle room on headlines?
No.
Like, is it?
I wish there was. Like, what we can quantify is there's been about 400 million paper barrels sold over the past couple of weeks. We'll get an updated number next week, and I think that trend will have continued. So unfortunately, all we can do is look at fundamentals. So we can look at demand. We can listen to comments from His Royal Highness Abdulaziz bin Salman, the Minister of Energy, Saudi Arabia, just this morning, saying demand is not weak. In fact, it's quite strong, and they have the best access from dealing with customers all around the world. We can look at proprietary data. We can look at inventory data in the United States. We could get it more easily globally. But unfortunately, there can be these chasms between the financial demand for oil and the physical demand. They tend to widen at times. And I think this, just like in March and just like in April, when you had an implosion, sharp sell-off, it takes a couple of weeks to figure it out. But we cannot identify. And we get access to some pretty interesting people to chat with. Nobody can explain the sell-off in the past week and a half.
Okay. In terms of what companies are doing in the interim, we're pretty busy with energy earnings. Companies like Suncor out with quarterly results. What do you see when you look at the profit picture for Canadian energy right now?
It's phenomenal. So again, you need to only believe in the oil price we were like 3 days ago. $80 is our baseline for investment decision making for 2024, and it's the same theme. So Suncor beat by 6%. Their guidance on Q4 looks a little aggressive, but we can buy into a sector where Suncor is trading at roughly 16% free cash flow next year at $80 oil. We've got TMX coming online, should be approximately March. So you'll have the differential for Canadian crude collapsing and staying low and less volatile for the next several years. So it's the same story. Yes, we've seen M&A. It's more selective than broad-based. We saw Crescent Point earlier by Hammerhead. And I think people are misinterpreting why these companies are doing it and what we've been calling for. We've been one of the biggest advocates for, just buying back stock, maximizing free cash flow, not growing, et cetera. What we're seeing selectively are some deals that make companies able to pay us even more on a pro forma basis. So that's the Crescent Point deal, and unfortunately, where the stock, they mistimed a bought deal right as oil was falling down. Banks are hung on it. Stocks have fallen off below deal price. But when you look at the merits of the deal, they've added 5 years onto their inventory. They've increased how much they're going to pay us by 11% next year. And they've made themselves a better company, the not worse company. So it's just short-term noise that we've got to deal with.
And do you think we'll see more deals?
Again, it's a selective basis. Riverstone, which is a humongous, massively successful private equity investor, they seem to have been monetizing this year. So they sold Pipestone to Strathcona. They've just sold Hammerhead to Crescent Point. So that's more selective. I think availability of private equity is still challenged. So you could see some private to publics, but I don't expect some en masse. You know, it's easy in financial models to make M&A make sense. There's a human element. It's very rare for somebody to want to voluntarily fire themselves from a job that pays them $4 to $5 million. And so when two companies merge, somebody's got to go, boards have to go, et cetera. So usually M&A is meant to solve two issues: weak balance sheets and inventory challenges. Balance sheets are their strongest, perhaps, in history for this sector at current pricing. And M&A, generally speaking, most companies have adequate inventory.
And have you felt enough conviction to say, you know, the market still doesn't fully appreciate the opportunity in this sector? I'm going to put more money to work in the energy sector right now?
Yeah, so we raised about $250 million 3 odd weeks ago. So we sold C&Q in the 90s. We thought it was reflecting $80 oil. We had trimmed some small positions. We've been trying to put that money to work. And what reaffirms what we're seeing is the collapse in share prices. Like, we were down 4.5% 2 days ago. We were down 2 odd percent yesterday. It's not from it's not massive selling pressure. It's just an absence of buyers. People looking at the volatility. They're saying, I can't make sense of this. I'm going to sit on my hands and stocks are falling. So we were bidding for large blocks. Like, we bought 1 million Crescent Point at $10.03. We've been buying, I'm not going to say which ones, obviously, but we're trying to accumulate. We're trying to put significant money to work, and it's much more difficult than you would think in a tape that's falling as viciously as it has been.